Silver feels rigged, and that is not a crazy thing to feel, because you can watch the price drop in seconds right after it starts to break out. You can watch a perfect looking move get smashed like someone pressed a button. You can watch the chart print a long red wick that looks like a hand reached in and slap the market. Then you look around and you hear the two loudest explanations. One side says it is all manipulated, always has been, always will buy, and the price you see is a lie. The other side says that is an excuse. You are coping. The market is fine. You just cannot handle volatility. And the reason the comments explode is because both sides are touching something real, but neither side is separating the real parts from the myths. So in this episode, we are going to do something simple, and it is going to make a lot of people angry, which is a good sign that it matters. We are going to separate manipulation from structure. We are going to define what illegal tactics can do, what they cannot do, and why silver can look rigged even when nobody is pulling a master lever. And by the end, you will have a clean checklist that tells you when the rig narrative is evidence-based and when it is emotional coping. If you want more episodes like this that turn comment wars into clear maps, subscribe and share this with one friend who screams, "It is rigged," and one friend who says that is an excuse, because this is designed to force the debate onto mechanics. Now let us start with the word everyone abuses. Manipulation. Most people use that word like it means everything they do not like about price. But manipulation has a real meaning in markets. It means specific actions that are illegal or abusive because they distort price discovery, usually in the short term, usually by creating a false impression of supply or demand. The key word there is specific, not vibes, not a feeling, specific actions that leave footprints. Now here is the second word that almost nobody uses, but it explains most of the pain. Structure. Structure is not a crime. Structure is the set of rules, incentives, plumbing, market depth, hedging flows, and liquidity constraints that shape how a market moves. Structure can create outcomes that look like manipulation. Structure can create sudden dumps, stop runs, ugly wicks, and violent reversals. Structure can punish the human brain because the human brain wants fairness and smoothness. And markets do not care what your brain wants, so you can have both things at once. You can have documented bad behavior in a market's history, and you can also have a market structure that naturally produces rig-looking behavior. And the mistake that destroys people is when they use one explanation to erase the other. If you say everything is manipulation, you stop monitoring the real variables, and you stop improving your process. You become a believer, not an observer. If you say nothing is manipulation, you become naive about the ways markets can be abused in the short term, and you ignore the need for evidence and vigilance. The honest position is conditional. Some tactics exist. Structure exists. The job is to tell which one is dominating in a given moment, and whether the claims being made match measurable fingerprints. Now let us talk about the most famous tactic in the silver lore, spoofing. Here is spoofing in plain language. A trader places large orders they do not actually intend to execute, to create the illusion of supply or demand, to influence how other participants react, then cancels those orders as price moves. It is a way of pushing the crowd with a fake shadow, and it matters because it can create short-term distortions. It can trigger stops. It can make price move faster than it should. It can create the feeling that the market is being shoved. Now here is what spoofing can do. It can create intraday chaos. It can worsen volatility. It can turn a normal pullback into a vicious flush. It can make technical levels feel like traps. It can create false liquidity, which is one of the most dangerous things in a thin market. Because false liquidity invites people to size up, then the liquidity disappears and they get destroyed. Now here is what spoofing cannot do reliably on its own. It cannot hold a multi-year ceiling against persistent real demand without the rest of the system showing stress. It cannot permanently override supply and demand forever without leaving larger footprints in deliverability, dislocations, and the cost of obtaining metal. This is the part that almost nobody wants to hear, because it removes the simplicity of the villain story. A villain story feels clean. If the reason you lost is a villain, you do not have to change. If the reason the market is brutal is structure, then you have to respect it. So let us build the structured case, because this is where the real education lives. Silver is structurally brutal for a few reasons, and they stack. First reason is thinness. Silver is not as deep as people assume. It does not take infinite money to move it. When attention surges, the market can gap and swing because the pool is not that large compared to how quickly speculative flows can arrive. A thin market does not need a mastermind to move violently. It needs imbalance. Second reason is leverage sensitivity. Silver attracts leverage because it is volatile and because people feel like they can get rich faster with it. Leverage is not evil by itself, but leverage creates a fragile market because leverage turns normal moves into liquidation moves, and liquidation is not rational. Liquidation is mechanical. When price drops and margin calls hit, selling happens because it must, not because it is smart. That is why silver can dump hard even when the long-term story is strong. Third reason is Silver's split personality. Silver is both a monetary metal and an industrial metal. That sounds like a nice diversification story until you realize it means silver can be pulled in opposite directions by the same macro event. If growth fears rise, industrial demand narratives weaken. If inflation fears rise, monetary demand narratives strengthen. If risk appetite collapses, liquidity drains, and leveraged positions get cut. Even if the fundamental story is unchanged, silver can get hit from multiple angles at once because it sits at the intersection of narratives. That intersection creates feedback loops, and feedback loops create the kind of chart behavior that people call rigged. Fourth reason is hedging and dealer flow. This is where a lot of people get confused, because they imagine the market is only buyers and sellers who want the price to go up or down. In reality, a lot of flow is not opinion. It is risk management. Producers hedge future production, industrial users hedge input costs, dealers hedge inventory, intermediaries hedge exposure. These flows can create persistent selling pressure during rallies and persistent buying pressure during declines. Not because someone is suppressing, but because someone is managing risk. To a retail viewer, that can look like an invisible hand that always appears at the same time. Sometimes it is an invisible hand. Sometimes it is a desk doing its job. And if you cannot tell the difference, you will build a worldview that is not useful. Now we have to introduce the most important concept in this entire episode. Two different silver realities exist at the same time. There is the paper reference market. This is where price is discovered through trading, leverage, and liquidity. And there is the physical reality. This is where metal must be delivered, fabricated, shipped, and made available in the right form. These two realities are connected, but they are not identical. And when they diverge, the rig narrative explodes because the divergence feels like proof. Price falls on the screen while premiums stay high. Price dumps on the screen while dealers are still tight. Price collapses on the screen while people cannot get certain products without waiting. So the mind concludes the screen is fake, but a divergence is not proof of suppression by itself. A divergence can simply mean different bottlenecks. Paper can flush because leverage on physical can stay tight because fabrication and supply chain constraints do not instantly change. So if you want to be serious, you cannot treat divergence as a conclusion. You treat divergence as a clue that you must investigate. Now here's the moment where I want you to feel this psychological trap. Silver punishes the human brain. You buy, it drops. You sell, it spikes. You wait, it runs away. You chase, it collapses, and then your brain tries to protect your ego. It says, this is not my fault. This is rigged. Sometimes that is emotional coping. Sometimes that is a rational suspicion. The difference is whether you can point to persistent, measurable anomalies that fit the claim. So the question is not, has bad behavior ever existed? The question is, if someone is meaningfully suppressing silver today, what would it look like? What fingerprints would it leave? Because extraordinary claims require fingerprints, not vibes. Now, we are going to Steelman the strongest version of the suppression story, because if we do not do that, we are just doing propaganda. The strongest version is not simply someone is pushing the price down because they hate silver. The strongest version is structural fragility. It says there may be many claims on silver through unallocated structures and derivative exposure, while the pool of deliverable metal is smaller than the claims imply. It says that in a stress event, the system could reveal strain because too many participants would try to secure deliverable metal at once. It says that concentrated positioning and the way the market is intermediated could allow certain actors to influence the short-term tape, amplify stop runs, and shape perception. It says that the settlement plumbing could create incentives to manage price around key windows. That is the strongest version, and it is not insane to ask questions about it. But asking questions is not the same as declaring victory. The difference is evidence. So here is the deal we are making in this episode. We are not going to insult the people who believe suppression exists. We are going to ask them to define what would change their mind, and we are not going to insult the people who say structure explains most of it. We are going to ask them to admit that illegal tactics can exist and matter, especially in thin markets. Then we are going to give both sides the same test, the fingerprint test, because if suppression is meaningfully active in a long-term way, it should not only show up as ugly intraday candles, it should show up as consistent stress in the system's ability to deliver and clear at normal terms. It should show up as persistent dislocations that arbitrage cannot close. It should show up as a chronic cost of immediacy that refuses to normalize, even when price is pushed down. It should show up in repeatable settlement behaviors that are hard to explain by normal flow alone. And if those fingerprints are not there, then what you are watching is likely a thin market behaving like a thin market, with occasional bad actors adding fuel, not a permanent ceiling held by an invisible god. Now let us pause for a quick ledger beat, because this will anchor the whole episode. You think you are trading silver, but most of the time you are trading liquidity, leverage, and hedging flows that reference silver. That is why it feels unreal, because you are not touching the metal. You are touching the system, and a system can move violently even when the underlying object does not change. Now, I want to give you the most useful reframe you can carry. There are two kinds of rigged feelings. The first is the market is rigged against me. That is usually a sign that you sized wrong. You chased, you used leverage, or you expected a smooth move in a market built for whipsaw. The second is the market is producing repeatable anomalies that do not resolve through arbitrage and that contradict the way it is supposed to function. That is where serious questions live. So how do we tell which one is happening? We build a dashboard, not a conspiracy board with strings. A dashboard of dials you can monitor, and these dials do not require you to be a professional trader. They require you to look at persistence, because a lot of bad behavior is short-term. A lot of structural tightness is episodic, but a true ongoing suppression mechanism would have to leave persistent, repeated footprints that survive different market conditions. So here is what we do next. We are going to build the fingerprint test that separates short-term ugliness from long-term control claims. We are going to define what you would expect to see if the market is mostly structure and leverage. We are going to define what you would expect to see if the market is showing chronic, abnormal stress that supports a stronger suppression concern. And we are going to do it in a way that forces the argument onto measurable signals. Before we go there, do me a favor. If you have ever argued about silver being rigged, leave a comment after this episode with the single most measurable signal you believe proves it. Not a feeling, not a story, a signal. And if you believe it is mostly structure, leave a comment with the single most measurable signal you watched to decide whether a move was leverage liquidation or physical tightness. This channel is not here to end debate by yelling louder. It is here to end debate by defining the test. So in the next part, we run that test. We build the rigged or thin dashboard, and once you see it, you will understand why silver can be both a market with bad actors and a market that is inherently cruel, and why confusing those two truths is the fastest way to get emotionally trapped in a metal that does not care what you believe. So here's the dashboard. Not a theory, not a vibe, a set of dials you can watch that forces the rigged debate to answer to reality. The first dial is the immediacy dial. This is the question of whether silver is easy to get right now, in the forms that matter without paying a penalty. When the market is truly tight in a structural way, immediacy gets expensive. Premium stays stubborn. Delivery terms tighten. Sourcing friction becomes a recurring theme, not a one-day panic. The system keeps charging rent for certainty. When the market is mostly experiencing paper volatility, immediacy may spike briefly, but it tends to cool when the rush passes. The system exhales. Premiums normalize, availability returns. So if someone tells you the screen price is fake, the first thing you ask is simple. Is the physical world consistently contradicting it for long periods, or are we just seeing normal retail bottlenecks and episodic congestion? If the contradictions are persistent across multiple channels, that is a real clue. If the contradictions come and go with retail waves, that is not proof of a hidden ceiling. That is the retail pipeline behaving like a retail pipeline. The second dial is the leverage dial. This is the question of whether the move you just witnessed was a liquidations move. In a leverage-dominated flush, the price falls fast, often faster than the narrative can update volume surges. Volatility jumps. You see the kind of move that feels personal because it seems to target obvious levels. It triggers stops. It triggers margin calls. It triggers fear. This is the part where people scream rigged. But a leverage flush has a signature. It tends to be violent and then mean reverting because forced selling exhausts itself. When the forced selling ends, the market can bounce hard. Not because a villain stopped, but because the selling pressure was mechanical, not fundamental. So when you see a brutal dump, you ask, did it behave like a liquidation cascade that burned itself out? Or did it behave like persistent suppression that kept pushing price down day after day with no exhaustion and no relief? A lot of what feels like rigging is simply leverage being revealed. The third dial is the deliverability dial. This is the question of whether the system is showing ongoing strain in the ability to deliver metal where and when it is needed. If someone is claiming permanent suppression, they are implying a long-term distortion that holds price down despite real demand. That would not only show up as ugly candles, it would show up as repeated stress in settlement and deliverability. You would expect recurring and persistent signs that the system is tight under the surface, even when the price is pushed down. You would expect the system to look like it is fighting the tape. If instead, the deliverability signals tend to spike during stress and then normalize, what you are likely seeing is a system that tightens episodically, not a system that is permanently broken. This is the key distinction. Episodic stress is common. Permanent structural failure is a much stronger claim. The fourth dial is the arbitrage dial. This is the question of whether dislocations close or remain broken. In functioning markets, when a gap opens between two related prices, professionals try to close it. They move metal, they trade spreads, they arbitrage. That does not always happen instantly because friction exists. But persistent abnormal dislocations that do not close are a signal that something is different. So the question becomes, when a premium appears, when a spread widens, when a dislocation opens, Does it close over time as the system responds? Or does it stay open in a way that suggests the normal closing mechanism is failing? If the normal closing mechanism keeps failing, that supports the idea of deeper stress. If the normal closing mechanism usually works after the storm, that supports the idea that the market is ugly but functional. The fifth dial is the narrative dial. This is the one nobody wants to admit matters, but it does. When does the rigged narrative spike? Does it spike after a sudden wick that hits stops? Does it spike after someone loses money? Does it spike when people are overconfident and then get punished? If the rigged narrative is mostly activated after pain, it can be emotional coping. If the rigged narrative is activated by repeated measurable anomalies that persist even when people are calm and profitable, then it can be irrational suspicion. So the narrative dial does not tell you whether the market is rigged. It tells you whether the person arguing has done the work to separate evidence from emotion. Now let us use the dashboard to answer the question that sits underneath every comment war. What can manipulation explain and what does structure explain? Manipulation, in the form of illegal short-term tactics, can absolutely explain some of the ugliness. It can explain why the market feels like it runs stops. It can explain why liquidity looks real and then disappears. It can explain why intraday candles look like someone slammed the price. It can explain why some breakouts fail in a way that feels unnatural. But manipulation alone does not cleanly explain the entire personality of silver. Structure explains why silver magnifies everything. Structure explains why the same metal can be calm for months and then become a knife fight. Structure explains why leverage turns small moves into big moves. Structure explains why paper can dump while physical stays tight. Structure explains why the market feels personal, because it punishes human timing and human emotion. So the honest answer is not either or. The honest answer is that structure provides a stage, and bad actors can sometimes throw gasoline on the stage. If you treat the gasoline as the stage, you miss the real risk. If you treat the stage as the gasoline, you become naive. Now, let me show you how this plays out in a moment that almost everyone has experienced. You see silver start to rise. You feel relief. You feel like the story is finally being recognized. Then the market slams down. A huge red candle. A wick that seems to appear out of nowhere. It takes out the obvious stops, and then it stabilizes. If you are emotional, you will call that suppression. If you are diagnostic, you ask, what happened to the immediacy dial? Did premiums collapse immediately? Did the system suddenly become loose, or did physical remain sticky? Then you ask, what happened to the leverage dial? Was volatility already elevated? Was the market crowded? Did the move look like a cascade that exhausted itself? Then you ask, what happened to the arbitrage dial? Did related prices drift and then close? Or did they remain broken? If the chart dumped, but physical stayed sticky, and the move behaved like a liquidation cascade, the clean explanation is thinness plus leverage, possibly worsened by aggressive tactics at the margin, but not necessarily a permanent ceiling. If the chart dumped and physical also went loose and the dislocations closed quickly, the clean explanation is that the market was simply overextended and then reverted. Now let us talk about the one claim that keeps returning, the claim that silver is permanently suppressed. To be fair, there is a reason this belief is durable. Silver has a history of disappointing believers. That disappointment creates a vacuum that conspiracy narratives love to fill. Also, the market really is opaque in places. The bullion world uses custody language and settlement structures that are not intuitive to normal investors. Analogated structures, large vault networks, and institutional flows are easy to misunderstand and easy to mistrust. So if you are suspicious, you are not stupid. But suspicion is not a conclusion. If you want the permanent suppression claim to be more than a feeling, you need repeatable fingerprints. So here is the fingerprint test in plain language. If silver is being held down in a long-term meaningful way despite real demand, then the system should show chronic signs of strain that do not resolve. You should see the price of immediacy stay expensive and abnormal. You should see persistent dislocations that arbitrage cannot close. You should see repeated settlement and deliverability stress that remains elevated. You should see the system behave like it is constantly tight underneath, even when the chart is pushed down. And if those things are not happening, then what you are probably watching is a thin market that whipsaws violently, sometimes influenced by short-term bad behavior, but not held under a permanent ceiling. Now, I want to go one step further, because there is a trap on both sides of this debate. The suppression believer can become so committed to the villain story that they refuse to adapt their timing and risk management. They hold through drawdowns with rage instead of with strategy. They buy every dip with certainty. They interpret every loss as proof. The structure skeptic can become so committed to the idea that everything is normal that they ignore genuine signs of stress when the system really is tightening. They dismiss the physical world. They dismiss deliverability signals. They dismiss the price of immediacy as irrelevant. Both are mistakes. The whole point of this episode is to keep you out of both traps. Now, let us put the dashboard into a simple workflow you can actually follow without turning your life into a research job. When you see a violent move that feels rigged, do not argue first. Check the immediacy dial. Is the physical world contradicting the tape in a persistent way or not? Check the leverage dial. Did the move look like a cascade that exhausted itself or a grind that never ends? Check the deliverability dial. Are stress signals recurring and persistent or episodic and resolving? Check the arbitrage dial. Are dislocations closing or staying broken? Then check the narrative dial. Are you calling it rigged because you are angry or because you see repeated anomalies that survive different market regimes? If you do that, you will notice something. Most of what people call rigging is actually predictable behavior in a thin, leveraged market. And the real moments that deserve deeper concern are the moments when the system stops resolving, when dislocations persist, when the price of immediacy stays high, when the plumbing looks strained for long periods. That is when the debate becomes serious. Now let us address the emotional core of this whole issue. Why does silver attract belief in rigging more than many other markets? Because silver is the perfect emotional storm. It is volatile, so it creates pain. It is small enough to move fast, so it creates shock. It is tied to money and fear, so it attracts ideology. It has a history of real enforcement cases, so it has a seed of truth that narratives can grow around. And it has physical versus paper divergence moments. So it constantly produces the feeling that reality and the screen are disconnected. So if you have felt the rigged feeling, you are not uniquely irrational. You are experiencing the exact psychological response the silver market tends to provoke. The way out is not to mock yourself, and it is not to build a conspiracy shrine. The way out is to become a system reader, because once you can read the system, you do not need a villain to make sense of the pain. You can say, this was leverage. You can say, this was liquidity thinning. You can say, this was a stop-run event in a thin market. You can say, this was physical tightness, persisting despite paper weakness. And that is the whole difference between feeling trapped and feeling informed. Now, we should end with the most honest synthesis possible. Silver can have bad actors, and silver can still be mostly driven by structure. Silver can have short-term distortions, and silver can still be priced by supply and demand over longer horizons. Silver can look fake on the screen and still be very real in the physical chain. So the correct stance is not denial and not paranoia. It is monitoring if the price of immediacy stays stubborn, if dislocations persist, if deliverability, stress repeats and does not resolve, then the concern level rises and you take the plumbing seriously. If the market shows episodic stress that resolves, if dislocations close, if violent moves coincide with leverage cascades and then mean revert, then the rigged feeling is more likely the result of thinness and fragility, not a permanent ceiling. Now, if you made it this far, you're exactly the kind of viewer who can actually benefit from silver instead of being emotionally destroyed by it. So subscribe, because the next episode will take this dashboard and apply it to a real recent move, step by step, so you can see how it works in practice. And share this with one friend who screams it is rigged and one friend who says it is all in your head, because both of them need to hear the same sentence. Stop arguing religion, start reading the system. And now I want the comments, because this is the cleanest way to expose whether someone has evidence or only emotion. Do you believe silver is suppressed today? Yes or no? If you say yes, what single measurable signal would change your mind? If you say no, what do you think causes the repeated stop-run feeling people experienced? And which dial do you personally trust the most? Physical tightness, leverage conditions, deliverability, stress, or dislocation persistence? Because once we agree on the dials, the debate stops being a war. It becomes a test. And silver, more than almost any other market, rewards the people who test instead of the people who believe.